John Weissman, Angel Oak Mortgage Solutions.
You guys hear me okay? Yeah, can you hear me okay? All right, awesome. Great, thank you, Vince. Again, I think I'm the keynote speaker, aren't I? You are. You are close to right, exactly. It really is great to be here. Two reasons. One is we just have very few of these live events, so it's so great to be back and seeing everybody. And just probably about a month ago, maybe not even a month ago, Camp had their first real live in-face person event, the pop-up event in Sacramento. And there were two vendors. We were there, Angel Oak and Louise Woods, and Art was there. So we went from two vendors, I think we have 8 back here now, so a 400% increase in less than a month. I'm pretty good at those numbers. And I think the total count of loan officers was 2. We had 2 loan officers show up, people that weren't vendors or part of the camp board. And I would think there's probably about 50 people here today. So I can do the math from 2 to 8. I can't do the math from 2 to 50. It's just way too much for me. It's probably not in a quarter. I don't know. Anyway, a big increase. And so that's the first reason. I'm just really thankful to be back out and seeing everybody. I'm glad you guys are here. I'm glad I can see your faces. We don't have to wear masks. I have mine somewhere, but I think I'm going to stay in here for the rest of the day because I don't have to wear it. Yesterday I flew up and I wore my mask from about 10 o'clock until about 6 o'clock. So I'm so glad I don't have my mask on. But the second reason is I want to talk to you about non-QM. But the thing that I always love about presenting at these kinds of events is that we are all the same. We are all here trying to accomplish the same thing. And that is to increase and expand home ownership in the United States. It's why we exist. It's what you guys are there for. It's what we're here for. And at our core, we are here to serve you. That's what we do. That's what we're here for. Our motto is that we bring Wall Street to Main Street, but really what we're doing is bringing non-QM to help you guys close more loans and expand home ownership throughout the United States. So I'm going to talk to you today a little bit about non-QM. I'm going to talk to you a little bit about the opportunity within non-QM, where we see the market growing. There's been a lot of cycles. Mostly what I hope is that there's dialogue. So I encourage questions. I don't want to be up for Vince, you said an hour and a half, I think, was how much of that? No, 45 minutes. So I don't want to stand up for 45 minutes and talk. I want questions. So as things come up, don't hesitate to raise your hand and we'll get to your questions as they come. So let me talk to you just a little bit about, this is kind of what we're going to do about when, where, why of the non-QM space. I'm going to spend a little bit of time talking about Angel Oak so you know who we are. But before I do that, can I get a show of hands? How many of you are from Oregon? Okay, most. Washington? Okay, good. Oh, great. Okay, good. Southern Washington? You guys mostly Vancouver probably area? Yeah, okay, good. How many of you are mortgage brokers? Okay, good. Mortgage bankers? Okay, keep your hands up, mortgage bankers. How many of you also broker loans or are okay brokering loans out of the mortgage bank? Okay, okay, good. All right. Credit unions, banks, anybody else represented here? No? Okay, the rest of you are wholesale AEs, Josh Jensen, yeah? Mm-hmm. Yeah, okay. And some competitors, we have some competitors. So anyway, it's great to be with you guys today. So let me tell you a little bit about Angel Oak. Angel Oak is a vertically integrated organization. What does that mean? It means absolutely nothing to you. But essentially, we are owned, our parent company is Angel Oak Capital. And Angel Oak Capital is the largest securitizer of non-QM product in the country. So Angel Oak Mortgage Solutions is their origination arm on the wholesale side, wholesale and correspondent. Angel Oak Capital buys every loan that we originate and then securitize it directly on Wall Street. That gives us some advantages in the marketplace. Most people, a lot of people that are in this business don't have that relationship. They have a third-party relationship with somebody else who maybe owns a portion of the company or doesn't own any other portion of the company, and they're just selling loans. So the fact that we're making our own decisions, we're making our own underwriting guidelines, we're setting our own price. We don't have to go to that third party to get decisions that gives us a real advantage. in the original. It gives you an advantage, and it certainly gives us at Angel Oak Mortgage Solutions an advantage. We talked about the securitizations. We are the leader in the securitization market. 23 securitizations of over $8 billion. And you know, these, when we first started doing this back in, the first securitization was 2015. And when we did our first securitization, nobody wanted to rate it. None of the rating, when you do a securitization, the rating agencies usually step in and say, we like this package of loans, and we're going to give it this rating, triple B, double B, A, triple A. Triple A is the best. Nobody wanted to rate it. So the second transaction that we did, because the first one performed so well, got the AAA ratings from the rating agencies that were involved, and that's been the case ever since then. And one of the things that I'm super proud of our company for is that even during COVID, in the middle of COVID, we actually did 4 brand new securitizations of non-QM loans right in the middle. There was about a month where non-QM shut down, and the markets didn't quite know what was happening. As did we, as did you and I, like who was going to live, who was going to die, who was going to keep their job, who wasn't going to keep their job, who was going to get toilet paper, who wasn't going to get toilet paper. Like you just didn't know, right? So that there were a lot of big questions, but during the middle of that pandemic, right at the heart of it, kind of from April through about June, we did 3 securitizations. And what that means is that the market came back very quickly. Okay, so for us, it was kind of proof of concept. We went through this massive stress test, which we hadn't been through since the start of non-QM. Non-QM started in 2013, and we had the wind at our back pretty much until 2020. We had low interest rates. We had really good employment. We had increasing real estate values. We had a really busy origination community. Everything was going in our favor. And then we all of a sudden hit this massive stress test. And what we believe happened during that period of time, we proved out our concept. This business is for real. It's here to stay. And the fact that we are almost back to pre-pandemic production numbers also proves that out. So lots of exciting things happening in Angel Oak. I say this, we are the largest originator of non-QM product in the country. I say it, and I believe it. If Louise was up here at ARC, she'd probably say it too. But it's hard to track these numbers. That doesn't really report non-QM production numbers. But really, the only way you can really judge non-QM production numbers is through the securitization market. It's very difficult to do it otherwise. This is what we specialize in. We did roll out an agency and a prime jumbo product after the pandemic, but this is what we do. This is our specialty. And again, I'm not going to spend a ton of time here because you guys are going to forget all this. Really, what you want to know is how can I produce loans? So we do give direct access to our underwriters. These loans all have error on them at some level. There's something going on that causes it not to fit agency guidelines or conventional guidelines. And so you brought it to us. And so it's really important that you guys have that dialogue directly with our underwriters to try and work through some of these issues that come up on a regular basis. It's one of the things I love about the space because every loan is different. It's incredible. We do take a common sense approach to underwriting, but one of the biggest things, and again, I'm going to talk about this in depth a little bit later. We believe that non-QM can help you originate more conventional loans. Okay? Most people don't think about it. When we make calls, I just looked the other day. We've helped, since our origination, we've closed about 28,000 non-QM loans since we started. And with that, we've helped 11,000 loan officers help close a non-QM transaction. Okay? That's why we think you should be doing non-QM. The numbers are getting bigger, and they get bigger all the time. But we believe this is a way for you to differentiate yourself. We think that our product, when you're talking to your referral sources, we think it can help separate you from other people that aren't doing these transactions. So keep that in mind. We do have a really good, intuitive, simple website, angeloakms.com. It's not hard to find. And I'm up here today because I have the title of Regional Sales Manager, but the people you really want to know are those two guys in the back. Russ Wright, the producing area sales manager, and Nels Erickson is a local account exec with us. Those are the guys that really know how to get loans done. I'm just eye candy up here. Hey, easy. Anyway, I'm going to try and keep this on track because we do only have 45 minutes. So what is non-QM? They've given me this slide, and it's fine. It really is the actual definition. But I'm going to give you kind of the real life definition. The CFPB was founded, it came out in 2013 and said this is what a qualified mortgage is. This is the box that you fit in to do a qualified mortgage. Non-QM is just stuff that doesn't fit. It really is just that simple. So what they have here is four things. A QM loan satisfies ability to repay. Non-QM loan satisfies ATR as well. Just do it in a different way. Okay, so every loan we do meets ATR requirements. There are some restrictions on loan terms, IO, other 30-year AM. We do IO loans on every loan. Not every LTV, but all products. And we do offer, and that comes with a 40-year term, 10-year IO with a 30-year amortization after that. There are some rules on fees where non-QM loans can charge a little bit more money. We don't see this very often, so it's not really that relevant. And DTI is a big issue. It's come up. The QM patch is kind of still in flux. We're not exactly sure where that's going to play out, and where DTI will eventually fall with agencies. But we have more flexibility there. We can go 40 on the front, 50 on the back on pretty much all of our products. But the one thing that's not up here, really, that is a majority of the non-QM business is doc type. Is really just documenting that income. That's the biggest difference between QM and what we call non-QM today. It's documenting. We'll get into the details of that. Yeah. Okay, so this is just a quick summary. I'm gonna get to each one of these, but the biggest portion of our business today is our bank statement product. It's about 60% of our total volume. We're starting to see an increase in the Dscr loan. One of the presenters talked about it before, and I'll get into a little bit more detail on what that is for us. It's a little bit different. And then this is kind of just missed. A lot of our full doc product is borrowers who just miss agency or prime jumbo guidelines. So you miss for credit score, or your reserves aren't high enough. There's all sorts of reasons why people fall out of prime jumbo or agency guidelines, and we think that this is our product, full doc, can help you fulfill some of those loans. The other thing that we talk about all the time is that we have products that have a little bit lower credit scores and a little bit shorter look back on major credit. And what we're looking for here, what we're really trying to solve for, is borrowers who have had a credit event in their life and now are back on track. Okay? So you guys know the difference, right, between borrowers who have had a credit event and borrowers who are a credit event. Right? There's some people that just don't pay their bills. It's not important to them, and those are the kind of people we're probably going to lend to. So if you have somebody that's just got a consistently high level of late over a long period of time, probably won't meet our guidelines. But if you have somebody who had a problem in their life and had an event, okay, you guys know what they are. There are all these life events that come up, and things happen. You can see that you can see it in their credit. Got perfect credit, great credit, and all of a sudden, like a year or two, and it's like awful. But then after that, they have their life back on track, and you can tell. You can document. One of the things that's amazing about our bank statement product is that with the pandemic, you can actually track it, and you can see what happened to them. They have these businesses, and they were doing great. February 2020, doing great. March, and all of a sudden, March, April, May, crap, and then all of a sudden, slowly, or some of them didn't get impacted at all. Like some people that you think would be impacted, like if you own a pizza shop, like there was no impact. I mean, their volume went up. Really, they sold more pizza, without a doubt. But you can track it. It's one of the things that's great about the bank statement product. And then people with no income, high assets. So if you have somebody that's got a lot of money in the bank, there's a lot of these people, They come into wealth, they sell a business, divorce sometimes. You see people with lots of assets, but no income, no job, no current income. We can help them. We have solutions that can resolve those problems. So this is one of my favorite slides. It talks a little bit about the market, and again, I'm not going to spend a ton of time on it because you really don't care, but we look to what was happening in the early 2000s as a way for us to predict what we think is going to happen in the non-QM business going forward. So if you look at what was happening, late 90s, the subprime business, you were a subprime producer, you were like in the streets and kind of greasy and like, you charging 5 points, and you really didn't want to talk to that subprime loan officer. But then all of a sudden, towards the end of the 90s and the beginning, certainly the early 2000s, subprime became common, and you started to see more people originating. I was running the company at the time, and we made a decision in July of 1999 to stop doing all agency business and just do subprime. That's all we were focused on, because we all of a sudden the demand was there for it. Now, I'll get to 2004, 2005, but early 2000s, these were still really smart subprime loans. These were good loans to good borrowers who repaid. Even if you look kind of through the market graph and you look at the securitizations that were done for originations in 2001 to 2003, these borrowers still paid. These were good loans, high credit score, lower LTV, mostly documented their income. We got a little bit creative. We look at that and say that was about 10 to 15% of the overall market. Okay? 10% of the originations during that period, 10 to 15% were subprime or non-agency. Okay? If you look at where we're at now, well, that was crazy. We lost our minds, right? So we started making loans we shouldn't have made. But if you look at where we are now versus the early 2000s, the evolution of non-QM is still in the first inning. We're still in the infancy stages of the product as a whole. Although we've proven concept, we still need more people to originate. How many of you have closed a non-QM loan in the last 12 months? Last 12 months. Okay, yeah, so that's about right. The numbers for us are about 10%. 10% is about the number. We think that there's 90% of originators throughout the United States who have never closed a non-QM loan. It's nuts. It's what gets me up in the morning. I mean, if we just go from where we are now, which is about, call it 1.5% of the market, maybe 2% of the overall market. I think this year the projections for non-QM are going to be $25 billion in originations, and you look at the overall market, they're projecting 1.7 trillion. So you're about a 1.5% of the market. Well, if you double it, my gosh, I mean, Ross and Nels and I will buy you all dinner. It really is. It's incredible to think about. Like, if we can get 10% of the market, we think that the non-QM space is $150 to $200 billion a year business, and right now we're at $25 billion. That's the projection for this year. 2019 was about $28 billion. Still nowhere close. So anyway, we think there's a massive opportunity for us, but we only capture that opportunity until we can convince you to actually originate a non-QM loan. So that's one of the things we're here to talk about. Some people are surprised by this. Some people think non-QM, they think subprime, they think hard money. That's not who we are. Our average credit score is 742, our average LTV is 71%, and our average DCI is 30. These are really good loans for really good borrowers at really good rates. This is not what some people think it is. So if that didn't convince you why you should care, these are kind of the reasons. We talked about this before. Be the standout resource. Okay, so we think if you're a borrower and they come to you and you say, well, I can get you 2.5%. Great, let's do it, close it. 2 years down the road, you think they're going to remember. If you're doing your job, they'll remember you. But if you don't do your job, they're going to remember their rate. they'll remember they have a 2.5% rate. They may not remember you. Okay? If you're doing your job and you're staying in touch, they'll remember you. But most people in the origination side of the business, most realtors, most mortgage, most loan officers, don't stay in touch with these borrowers. So they'll remember they have a 2.5% rate. If you're a borrower and you get declined by 3 different lenders, and you are trying to buy the house of your dreams, and you get declined by 2, 3 different companies, and the loan officer comes in and says, you know what, I can help you because I originate these loans that can help you close this transaction so that you can get into that house. In 2 years, do you think that the borrower is going to remember their rate? They're going to remember you. We believe that these products help you get more referral sources. They help you stand out with your referral sources. So when you're walking into a realtor's office and you're saying, I have great rates and great service and I'm really nice, they hear that from everybody. They hear that from every loan officer who pitches. Instead, we think if you come in and say, I have great rates, great service, I'm really nice, and I can help you get deals done that other people can't. And here's how. That's a differentiator. And we think that you should be, and we'll talk, we have some marketing material that you can use if you're approved with us that actually presents that concept to realtors around the United States. And obviously, we wouldn't be here if we couldn't make more money. Okay? So that's great. So we're all here to make money. We do think that it can increase your earnings. Saving agency fallout happens a lot. We think that a lot of the transactions that we do are not going to stay on our books forever. And if you're doing your job, you can actually refi them out into a conventional loan down the road. And we can, that's what some bank statement loans. Somebody had a credit issue, their credit's back in line now. You can help refi them out into an agency deal. Sometimes bank statement borrowers are always bank statement borrowers because they always write off as much as possible. They have to take advantage of the tax code. But if you have borrowers who just had a year or two where they couldn't qualify, and now they have their income back on track, their tax returns are showing a little more income, you can refi those borrowers out into a conventional deal sometimes. It increases your referral sources. I don't love this slide because it's really negative selling. It talks about what happens if you don't do non-QM. You lose that referral source. So this happens all the time, right? We'll walk into shops and say, I don't do non-QM. I don't do non. Okay. What do you do with the borrowers that you have to decline? I love this. I don't decline. Who doesn't decline? I love that one. Well, what do you mean you don't decline? So what do you do with borrowers who don't qualify? Let's say you don't decline them. You don't take the app because you don't think they can qualify. Well, I let them walk. I guarantee you, if you're a self-employed borrower and you turn that borrower away, look to your left, look to your right. There was 10% you rose your hand, and you're doing them. You're going to lose that loan. You're going to lose the referral source. You're going to lose the relationship with that referral source. You're going to lose the relationship with the borrower. You lose immediate earnings, and that client is gone. They're not coming back. Yes. All occupancy types. Owner, second home, non-owner. Yep. Okay, so let's talk about the borrowers themselves, and then I'm going to hopefully we'll get on to the product. Okay, this is kind of for your standpoint. One of the things that we love to do is help you guys originate non-QM loans. Some of that is knowing the product, but mostly it's knowing who those borrowers are, so that you can go get them, so you can go find them. Okay, so one of the ones that's growing like crazy for us is investors. You guys have all seen Fannie and Freddie restrict their deliveries of non-owner and second homes. That's just the beginning. So they said, we like you, mortgage banker, but we only want, instead of 10% of your volume as non-owner, we only want 7% to be non-owner. Okay, so there's been this restriction. And we think that the agencies are going to continue to restrict their platform and do less volume for investors and for second homes. We think that's just the beginning. We think those restrictions are going to continue, and we think they're going to get more. So what we've seen is a massive increase in our non-owner business. non-owner full doc, non-owner bank statements, and non-owner Dscr or investor capital. And if you look at it, it makes sense, right? I mean, 36% of homes are rentals. There's a gold mine for you. If you're not out looking for investor clients, you should be. They are a great source of non-QM business, and we think that our products can help you originate more. 10 to 11 million are the number of investors who are managing 1 to 2 units by themselves. So this isn't like this. I mean, there are some major hedge funds that buy investment property. That's not your client. These are your clients. There's 10 to 11 million of borrowers who own a rental property. And if you look at kind of what's happening in the marketplace, you guys have refied all these people into 2.5% mortgages. If they want to move up, do you think they're going to sell that house? They're not. They're going to keep that house as long as they can because they have this incredible leverage. That 2.5% mortgage. Why would you walk away if you can afford it, right? So those people are sitting in your database now, and we think that you can help them. The second one is self-employed borrowers. These numbers, 36% of the U.S. workers are somehow participating in the gig economy. 59 million Americans are participating. These are incredible numbers. These are the people that need bank statements. These people need bank statements. Either they're fully in the gig economy, self-employed, or they have a W-2 job and they're just doing this to make some extra money. We can help some of those people with our bank statement program. So one of the things people don't realize with bank statements, you have to be self-employed, but you don't have to be fully. You can also have a W-2 job. You can have a spouse that has a W-2 job and combine borrowers. That's possible. So as long as the self-employed borrower contributes at least 30% of the total income, you can do a bank statement loan. That is the same for spouses. So people that are married, one of them, as long as one of them is self-employed and has at least contributes at least 30% of the total income, you can do a bank statement loan. It also is true for single borrowers. So if you have a single borrower and they have a W-2 job and they also participate in the gig economy, you can document that income through bank statement. As long as that income is 30% of their total gross income, we can do a bank statement loan rather than going full doc. People forget that all the time. We talked about this adverse credit events. 5 million foreclosure filings since 2014. There's lots of big questions about what the pandemic is going to do to foreclosures. I don't think it's going to increase as much as some people do because of forbearance, because of all the economy is doing pretty well. I don't think you're going to see a huge spike there. But there are 5 million people plus since 2014 who have filed for bankruptcy. Those are clients that you can call on and fit them into non-QM products because our look-backs are shorter. Agency look-backs, prime jumbo look back, sometimes never, sometimes 7 years. We have products that are today, I think we just changed our guidelines. One of them's like, no look back. Most of them are 1, 2, or 4 years. Okay, how am I doing on time? They also, what am I up to? So one of the things that you hear a lot of people talking about is trying to scare you. Refis are going away, so sell non-QM, and this is why. Refis are going away. Replace your pipeline. I don't know. I've been doing this so long. When we first started in the non-QM space, we had the same slide in 2013. We always think rates are going up in the non-QM space. We always keep saying rates are going to go up. Rates are going to go up. Sell non-QM. Rates are going to go up. Sell non-QM. I don't have any idea. Maybe they are. Maybe it sure sounds like they're going to go up. And if they go up, but if I saw a report today, 3%. If agency rates are at 3%, there are 15 million borrowers who are in the money for a refi. 15 million still. They're in the money for a refi. I mean, you guys are going to be busy here unless something happens with rates. Who knows? I don't know. But what we do know is we think this is an additional product that can help you close more loans. And and this is a projected rate increase from the NBA. So, again, who knows? People are guessing. That's kind of who we do business with. We already talked about it. So let's get into some of the details, okay? Bank statement loans. Bank statement loans is really simple. Don't overcomplicate this. I think one of the reasons why we feel really good about the non-QM space expanding is because this really is just like a regular loan. There's really nothing different to it. It's just like a regular agency conventional deal. The only difference is we want to look at that income a little bit closer to the same loan. Okay? You guys originate an agency loan, you get tax returns, W-2s, you're experts. You know exactly what that income is going to be. No questions. But when there's a bank statement loan, it's like, I don't have any idea. I don't know. I don't really know. And so what we do is we try and take the pain out of that process. And I'll talk about it in a minute, but I'll just start right now. We have a team of people. All they do all day long is evaluate bank statements for income. Okay, so that's all they do. You send us a 1003, a credit report, just so we know the deal's for real. And you send us the bank statements. We have a team of people in about a day and a half. We'll get back to you with what your income is. And then you can go shop for a house. You want to have that pre-approval, right? When you're out, you can't do it without it in this market, that's for sure. So you want to have that income nailed down up front, and we'll help you do that. So bank statements are for self-employed borrowers that don't qualify for a full doc loan. However, one of the other pieces that we have seen recently, especially in this real estate market, we had a story about 3 weeks ago. A borrower qualified for $1.5 million mortgage, actually $1.5 million purchase, full doc. They were sending it to somebody else. One of our reps walked in and they said they're really struggling. This is all full doc they can afford because that's all I can qualify for. But they really want to buy a bigger house so that they can compete better. This was in Southern California. Okay, so $1.5 million inventory in Southern California is very limited. Well, the borrower wanted to see if they could qualify for more money. So we said, he's self-employed, great credit, great borrower, never late on the mortgage, never late on a revolving debt. Get us the bank statements. This is somebody that's qualified, full doc. It's done, right? So we looked at it. Their purchase price went from $1.5 million to $3 million. So they doubled their purchasing power. People don't think if a borrower walks in and they qualify full doc, people don't think maybe I should look at the bank statement product to see whether or not I can get you more purchasing power. Now, some borrowers may not want to go make that jump. They may not make it. But we believe that you can increase your purchasing power almost always. So if you have a borrower that's struggling to compete in this particular real estate market at whatever purchase price you've got them in, and they're self-employed, there's an opportunity there for you to help people qualify for a bigger mortgage. Two-year look back on credit, major credit, loans up to $3 million. We'll actually do loans above that. This is just a stated maximum. Self-employed only, they have to be self-employed for 2 years, not 10 years, 2 years. And if you can use either business bank statements or personal bank statements. If you use business bank statements, they have to own at least 50% of the company. Okay, so if you have a business and somebody owns half of it, then we think they can probably control half the money, and so they can use it. If they only own 49% of the company, then the 51% owner probably controls the money, so you can't go down that road. You gotta. Okay, so business bank statements, they have to own at least 50%. Most of what we see is 100. You can use personal bank statements as well. So most of what we see is business bank statements, but you can use personal bank statements as well. And then the personal bank statement program, you have to own at least 25% of the company. Okay, so theoretically, if you own 25% of the money of the company, and that money is coming into your personal account, once it hits your personal account, it's yours. The other 75% owner doesn't have to say that once it hits your personal bank account. 12, 24 months. This is just a really good loan, and I think most people are comfortable with this at this point. We've been doing this since 2013, so I think most people are comfortable with this concept. But any questions about this before I look? This is where we really get most of our questions. Yeah.
And then figure out, like, you the personal or the business.
Yeah. So the question is, do I use personal statements or business bank statements? And that's a great question. If they have both, then what we normally see is there's more income coming through the business bank statements, okay? And so it's normally the best way to go is using that business. But a lot of times what happens is you have money coming into the business. They pay all their expenses out of the business account, and then they funnel all that money out of the business account into their personal account. So the personal account then becomes net income. Okay, so they're paying themselves basically through that personal bank statement. Under that situation, a lot of times it makes more sense to use personal statements. But what I'm saying to you, you don't have to know that. We'll do that work for you. You know, you can look at the bank statement. I mean, somebody sent me a set of bank statements the other day. Wanted to know if they qualified, and it was 12 months. It was like a 450 loan or something like that. And I looked at the first three statements, and the deposits were $1,000, $1,500, $500. Those were the first 3 months. Like, what? You guys know, they're not going to qualify. If you just, give them all the income, they're not going to qualify. So I think it's important for you to take a look, go through the numbers, just scan it, and see whether or not you think they're going to qualify. But most of the time we'll do that work for you. But what we see mostly is business bank statements. Yeah. So then the question becomes, how do we calculate income? And again, this is one of those things. Everybody does it different. The non-QM space in this early stage hasn't commoditized yet. Everybody handles this a little bit differently. We apply for our business bank statements, actually all bank statements, a 50% expense factor. So what you're trying to get to here is net income for the business, okay? So you take the gross deposits from that account over 12 or 24 months, and you cut it in half, and that's your net income. Divide it by 12, and that's your monthly number. There's all sorts of things in between there that are nuanced. What we count, what we don't count, transfers, large deposits. There's all sorts of other things like that. That's why we say to you, let us do that for you, and then we'll tell you what your income number is going to be. Yeah. Yeah. So right, good question. So the question is, if you own 50% of the business, did you get credit for all of that? No. You cut the income in half because they only own half the business, then you cut it in half again. Yes.
I'll do a little advertising. So here's one line. Look at this one. They wouldn't even sit on a call with Russ. I did this deep refresh, right?
Yeah.
So one of my favorite deals was $1,350,000 purchase. They had 3 different realtors. The realtors sent their loan officers, said they don't qualify for anything. We closed 90% on $1,350,000. So just closed another purchase with Russ a couple weeks ago. Do
you want the mic?
No.
Right. Right.
Right. Send them in, and you'll get the number as soon as you grab that 50%.
Yeah. Yeah.
But the funny part I want to say about the coworker, so he's too above this, right? This is not for him.
Right.
So anyways, we have a shared processor, right?
Yeah. Yeah.
It's like, where's Kroger doing that thing? Because yeah, he goes falling apart. It's $1 million purchase.
And he closed it. Yeah.
And doing that. So
there you go.
He's above that, right?
Right.
All of a sudden became important because it's top realtor, and he tried to run it through, and then he couldn't do it. So that's what we were doing at California. That's the deal in our offices. But it's done.
Yeah. Thank you. Thank you for sharing that. No, it's a typical story. I just don't want you guys to be that LO. Don't be the LO that's letting these borrowers go someplace else. They are going someplace else. They're getting done. You can see it happening. It's happening. Well,
3 different realtors they went to.
Yeah.
And they sent them to 3 different loan officers and said no. And then these people called on me, you're good. So.
My job here is done. No, it's incredible. Thank you for sharing that. No, it's that we hear these stories all the time. And what we're saying to you is just don't walk away from these borrowers. You know, make the call. Even if you're not sure, like, I don't know if it's not, call, make the call. Just walk it through. It's what we do all day long. We take scenario calls all day long. Hey, I've got this borrower. Can you help? That's what we do all day. And we have experts that are here to help. Okay? So local people in your community that are here to help you resolve these big questions. But thank you for sharing that. I really appreciate it. Any other questions about banking? Yes. Yeah.
Why would Jerry use a partner?
Great question. Question is, I have the business statements, I pay my expenses out of the business account, and then I funnel all the net income into my personal account. Why would we use the personal account? Because we're not going to apply an expense factor to personal that situation. Okay? Because theoretically, you don't need that income, you already have net income. The net income is what's funneling into that personal account. So that's the reason why you would use that. We see that from time to time, and that's a good thing. No, so there's that exception, which we see from time to time. The other exceptions are if you have somebody that works from home, self-employed, no employees, very little overhead, no inventory, we'll lower our expense factor from 50 down to 30. So we'll lower it for those borrowers that have lower expense factors. We were pre-COVID, we had a 15% category. We're not quite there yet, but we'll be close. And then on the other end of the spectrum, we do have some businesses that have historically higher expense factors. Heavy manufacturing, lots of employees, multiple locations, retail stores that buy inventory and have employees, really low margins. We'll actually reduce our expense factor to 70% for some of those. So keep that in mind. But all great questions. If you have more, I'm going to be short on time, so just come by the booth and be more happy to answer some of the questions. Okay, investor cash flow. You guys already heard a little bit of this from one of the previous speakers. This is the Dscr loan. It's debt service coverage ratio loan. It's the easiest loan you could ever originate in your life because you're not looking at any income. We get 1003, no employment, no income. We're not calculating DTI. We're not calculating residual income. All you're looking for is the borrower's credit and the cash flow from the subject property. So our limit right now is 80. We'll go to 80% LTV. And as long as you have 1-to-1 ratio, as long as your rent covers PITI, positive or break-even cash flow, you got a loan 80%. The great news is for us is if you have a credit score of 700 or higher, 75% LTV or less. So 700 score or higher, 75% LTV or less, you don't need to cash flow. So the property can actually lose money every month, and we'll still loan on it. It's the easiest loan you could ever originate. So when I say these borrowers are in your database now, they are in your CRM. Go find them. Go look at the borrowers that you closed non-owner loans for 3, 4, 5 years ago.
That's a no-go.
It's no income. Yeah, it's no. Well, you still have to provide assets. Our reserve requirement 6 months. Yeah. But we're not looking at bank statements. We're not looking at pay stubs. We're not running a 4506. This is a business purpose loan. Okay. It's you can close it in an LLC. The loan's made to the borrower, but you can close it in an LLC. We don't care about how many properties you own. We don't care about how many properties you have financed. Just one second. Yeah. Great question. Yeah. So the question is, do you use what the appraiser says for rent or actual rent? And the good news is it's the better of both worlds. Whichever one you want. Whichever one. So however, we usually use the appraiser's 1070. We usually use that. But if you have a property, we don't see this as much anymore, but every once in a while you get a property where the market is 3,000 and the actual rents are 3,500. We don't see it much. But if you can prove that you have a lease in place and you can show deposits, 3 months worth of bank statements that shows those deposits coming in, we'll give you credit for the higher amount.
So you use a jumbo?
Up to $1.5 million. I've seen a couple of exceptions above that. If you have lower LTVs, you just don't see a lot of non-owner at that level, but we have done some a little bit bigger. Love it. And this is 100% of those rents. So you get credit for 100% of those rents. You don't take a 25% discount like the agencies do. So you take market rents as long as market rents cover PITI. You can go to 80% LTV or higher, or less. Yeah, down to a 640 score. So the borrowers don't have to be perfect. We do have some pretty strict guidelines as it relates to recent mortgage rates for these people. You don't want to be lending on these for people that have tough credit recently. But any questions on this? Oh yeah, you had a question.
Has to be non-owner?
Yes, it has to be an investment property. We have to be able to, a third party, like somebody looking at it doesn't know anything about the mortgage business, has to be able to say it's an investment property. So to be honest with you, probably the biggest reason we decline is because people are trying to do this product on a purchase for if they're owner occupied. So we see that a lot. So if you live in a 2,500 square foot house, 3 bedrooms, 2 bath, that's worth $500,000. You're trying to buy a 5 bedroom, 3 bath, 4,000 square foot house. We're probably not going to call it an investment property. I know a lot of loan officers want to call it an investment property, but yeah. 6 months. Yeah. Yeah. You want to add something?
I was just going to say, for the appraised value, we'll actually do cash out on this program with 6 months. Yeah, so it's a big distinction.
Yeah. Yeah. So if you didn't hear that, 6 months seasoning or cash out. You can use appraised value after 6 months. What I got, like 5 minutes? So we do have a couple of other products, but one of the I talked about purchasing power. The other thing that I want to talk about is a recent development with us, sort of post-COVID, that is something that we think that you should be selling in this market is delayed financing. So we offer delayed financing on all of our products. You can offer it at any level, and it's your normal delayed financing. Somebody pays cash, and if you refi them out within 6 months, we're going to underwrite them to purchase guidelines, which means you can go to 90% LTV and get cash out up to 90% LTV on purchase as long as you qualify for that loan. So that's something that's really big. In this market, people are trying to compete with cash, and so we think you should be going. It happens all the time. You guys do all the work, pre-approve them, and then I got cash. I can't wait. We're competing, and then that customer's gone. They're not gone. Don't think they're gone. Go back to them and say, I give you any doc type, any product. Within 6 months, if they want to get their cash back, they can come back to us. Yeah. Interest only on all of our products. Okay. So the other thing that we added, that's the traditional delayed financing, which is a good product, and we think you should be selling it to those people that go cash. The other thing that we added to it is if you took out a hard money loan, a private money loan, or you got a loan from your uncle to buy the house, just you needed the cash in order to get that house. If you pay that off in 90 days with us, we're going to look at it as delayed financing. Okay, so happens all the time. Gotta close quick. I can't wait 21 days. I can't wait 30 days. I gotta close quick, so I'm gonna go to the hard money lender and I'm gonna close it. Don't wait a year to pay that off. Don't wait a year to pay that higher interest rate. Pay it off now and get into a better transaction. Most of them are lower LTV, so you can actually get higher. You can get to 90% with us as long as they qualify. It's a great addition to our delayed financing. So for any of those borrowers that are getting creative to close in this market, keep us in mind. Yeah, question in the back.
Is this on mixed-use properties?
We do not allow mixed use. Yeah, residential 1 to 4 only, no mixed use.
Just not mixed use, you have a problem with ADU. to that?
Yeah, ADUs are always a little bit tricky. As long as you can get comps, you know, we should be fine.
Up here, there's a lot.
Yeah, I know, we do run into it. Yeah, yeah. We don't do non-owner rural. So we do run into that a bit up here. There was no other question. No? Okay. So I'm almost out of time. This is an asset qualifier loan. I'm not going to go into the details of it. Basically, if you have enough money in the bank to pay us off, we'll get you a loan. Not exactly that, but if you have enough cash, you know, call us. If you have enough, it takes a little bit more than just purchase the loan amount, but anyway, it's a good loan if you have people to have lots of assets. We offer 3 different full doc, prime, jumbo, or they don't have to be jumbo, but they 3 different products on the full doc side. And again, these are products that are used for fallout. That borrower just didn't qualify for that bank prime jumbo. They just missed for whatever reason reserves. Our reserve requirements is only 6 months. Some banks are 12 or 24. Our credit look back is only 2 years. Most banks are 7 or not at all. So if you have somebody that just missed prime jumbo guidelines, definitely keep us in mind. We have multiple products here. And I'm not even have time to go through our pricing, our tools, because I'm out of time. But we go to our website, angeloakms.com. You don't have to have any login. It's open to the public. You can price out any transaction at any time. Okay? angeloakms.com. Non-QM quick quote. And you're sitting there with a borrower trying to figure out, hey, what? I can't go full doc. You don't work full doc, but I have this other option. Okay? Let me go to Angel Oak's website, and as I'm sitting there with the borrower, price it out. You know their credit score, you know their loan amount, their LTV. You know all these things. It's very, very basic. It's 6, 7 pieces of information. You can find it, and you can get a price. Okay, so keep that in mind. This is a snapshot of it. It's very, very simple. 7 or 8 questions, and not only do you get pricing.
Qualified now, because we get that.
Yeah.
So our company has 15% trailing average. So if you go look at those investors, it's off it's like 3, 4 point hit, right? So
yeah. Right on our non-QM product. Yeah. So what he's saying basically is in-house agency non-owner pricing is higher than our non-QM pricing. Okay.
What happens?
Right. Right.
So the issue is I had 5 downloads like proposals already.
Yeah.
We had locked in like 3 points per.
Yeah. No, it's crazy. Yeah. Yeah. Yep. Yeah. No, it's a great story. Yeah, you can. Yep, doc type. Yep, exactly. Yep, thanks, David. Investor cash flow. So once you get your pricing, we have an online tool that actually helps get the documents to us securely. And this is our non-QM quick wall. You upload a 1003 credit report into the bank statement, loan bank statement, and it goes directly to the account executive. And that account executive will pre-qualify that loan for you. The bank statement loan takes about a day and a half. If it's a regular loan, it takes basically the same day. You'll have an answer back as to whether or not your borrower qualifies, so that they can go out and compete in this marketplace. Okay, so super important. I'm not going to go through the details there because I'm out. Vince is going to shut my mic off at some point. We talked about the bank statement review team. This is what they do for a living. They just evaluate your income for your borrowers. And we do have a chat line for those of you that can't figure out our easy website. But it's live, and people are there to help you. And then, this is one of the other pieces, and one of the other reasons why we don't think we get a lot of business is because a lot of mortgage bankers are. Matter of fact, I had this conversation. We rolled out a mid-sized mortgage banker 2 weeks ago, and they're implementing our product for the first time. And I got 2 questions from loan officers that have been in the business for 20 years and said, I haven't brokered a loan in 20 plus years. Okay, these people are doing everything in-house. You guys know the transition since the crash. Okay, since the Great Recession, most originators moved from brokers to bankers or a bank, and they just have never brokered a transaction before. And what I'm saying to you guys is, it's just, if you're in that space, just sit with us for a couple minutes. It's just not that complicated. It really is. It's just, instead of you passing that loan to your internal staff, you're passing it to an external staff. It's really not that complicated. These loans are just like conventional loans, except for some of the doc sizes. And I don't have time probably to go into all of our marketing material. I'm just telling you, if you get approved with us, we have massive opportunity for you to promote yourself as a non-QM expert. This has nothing to do with Angel Oak. This is us giving you the tools that you need to promote yourself. Because there's two ways to do non-QM business. There's three different originators. The first originator is this one that you were talking about. I don't do non-QM. Okay, fine. I'll do it for you. We have people that will do it. That loan's going to get done. Okay, so that's the first one. I just don't do non-QM. I don't know why. I can't figure that out. I guess they have a system. I really don't know. It's surprising. Yeah. So the second step into non-QM is fallout. I have a deal. It didn't get done on the agency side. Let's call the non-QM guy and see if we can get it done. Okay, that's that first step in the non-QM. The second step, where we're doing most of our volume today, is people that are actually marketing it for us. You're taking our marketing material and you're promoting yourself on social media, to your realtor base, to your referral sources. And I'm a non-QM expert. I can help you get those harder transactions done. And we think this is an opportunity for you to grow your business, again, to expand home ownership throughout the United States. We talked about this. I'm pretty much done on it. I'm going to keep going until he shuts my mic off. I can be up here for an hour and a half. So I will say one other thing. Okay, this is sort of a segue from what I just talked about. Realtors, obviously, I can't tell you how many realtors do bank statement loans. We do more bank statement loans than realtors. So if you're calling on realtors, you should be asking them about their home loans. We do a lot of these loans for real estate, and they've had a great year. So maybe their tax returns haven't shown it yet. That's okay with us. We're okay with that. But the second one is a huge source is other loan officers. Okay, you brought it up. If your guy that actually did the loan didn't want to do it, you're going to do it for him. Okay, and you're getting referrals. You're getting referrals from other loan officers that are walking away from these transactions. Big bank loan officers, they can't do them. They don't have a choice. Okay, if somebody works for Chase or B of A or Wells, they cannot do a non-QM loan. You should be talking to those loan officers. And if you have a referral, I have a guy. One of our clients used to work for Umpqua. Umpqua can't do these loans. You know an Umpqua loan officer? You should be buying them lunch and trying to pick up those leads. Okay, it's a great source of business. And there's some other pieces here. Hard money lenders is another one. People make hard money loans. They want to get them off their books. Our Dscr product is a perfect solution. Our investor cash flow is a perfect solution for hard money lenders that want to get deals off their balance sheet. I don't even know what that says. Anyway, that's our marketing material. Differentiate yourself. This is who we are. Thank you very much, everybody. It's been a pleasure. Thank you for your time.
So you know what I said on Facebook Live is streaming right now? How about it? Thank God. That camera on Facebook. No. Well, this is a great course. Thank you, John. Thank you.